It's another interesting edition of the Market Review where we discuss key developments in the financial and capital market as it affects the economy. Our focus today will be on Budget 2023 implications for the Nigerian capital market. And my guest is Professor Uche Uwaleke, the President of Association of Capital Market Academics in Nigeria. Nice to have you once again on the program, Prof.
Yeah, thank you very much, Abbas. It's my pleasure indeed.
Thank you. And to our viewers, before we begin the conversation, let us give you a wrap of some major market stories from last week. The Chief Executive Officer, NGX Regulation Limited, Tinwade Awe, called on stakeholders to do more concerning environmental, sustainability, and governance, stressing the need to re-examine current frameworks. She was giving her keynotes at the Association of Sustainability Professionals of Nigeria webinar held recently. Awe said that stakeholders should begin to prioritize actions that will help address global development challenges affecting ESG disclosures, noting that opportunity was abound for both private and public sectors to enhance sustainability output. Also last week, the FMDQ announced the registration of the Emerging Africa Capital 15 billion naira commercial paper on its platform. But it was a big one for Afex Commodities Exchange as it launched its Grain Quality Enhancement Center in Kaduna State. Those are some of the very key stories from the market from last week. If you're joining us, it's the Market Review, and our conversation today is on Budget 2023 implications for Nigerian capital markets. My guest is Professor Uche Uwaleke, Professor of Capital Markets and President of Association of Capital Market Academics in Nigeria. Prof, let's get down to the conversation. And when you look at the 20.51 trillion naira budget presented by President Muhammadu Buhari to the National Assembly, there are key assumptions that has been already aligned. I just want to get your take first, assessing the assumptions for the 2023 budget, which, of course, are very, very clear. Some of them that we are aware of are the $70 benchmark for crude oil, the 1.69 million barrels per day production, and of course, the 435 naira 57 to a dollar. That's exchange rate, and then, of course, the projected growth rate of 3.75%. and 17.16% targeted inflation. I just want your take on these assumptions. Are they realistic or is it too ambitious?
Well, I think on balance, they are realistic. I would say that some of them appear realistic, while some others are not. The ones I consider realistic include the oil price benchmark of $70 per barrel, considering trend, considering forecasts by reputable energy agencies. I think $70 per barrel is a conservative figure to use. When you are budgeting, you use something conservative. You don't, you're not so optimistic. So $70 per barrel, in my view, is in order. The other benchmark I also think is realistic is the production level of 1.69 million barrels per day. Again, that's on the back of what we have been told, that the government, especially through the NMPC, is doing something about oil theft. Part of why we have not met our budget projections for, if you recall, for 2022, it was 1.6, but we never met it. It's largely on account of oil theft and pipeline vandalism. So if something is done about it, and government is making us believe that they're working on it, I think 1.69 million barrels per day, given the fact that it is still below the OPEC quota of 1.8, is realistic. For exchange rate, yes, 435.57 naira to the dollar against the 410 to 15 that we used in 2022, has already provided for depreciation of the naira. Doing anything further than that, could create some distortions in the economy. And against the backdrop of the central bank's ROT 200 policy, I think it's 435 naira to the dollar is also realistic. But the ones I don't consider realistic are inflation rate of 17.16. And that's because of majorly because of the fact that the budget proposal is assuming that oil subsidy will go by July.
Yeah.
If oil subsidy goes by July, I don't see inflation rate staying at 17.16. It will trigger in the near term, some spiraling in the domestic price level. Again, you also notice that this year we've experienced some effects of climate change, flooding in many parts of the country, and I see that feeding into price level in 2023. So inflation rate 17.16 may not appear realistic. And the other benchmark too, which is in my view unrealistic, is a 3.75% real GDP growth rate. And again, that's on the back of both global and domestic headwinds. Already the World Bank is and IMF, they are all being pessimistic about real GDP growth rate for 2023. We see them already downgrading, or rather, revising their forecast down, downwards for real GDP growth. As a matter of fact, the recent one we have now from the IMF is that the real GDP growth rate will come down to 3.2% for 2022, 3% and further down, next year. So if you look at the projections for real GDP growth, and you also factor in the fact that the central bank of Nigeria, as well as global central banks, in a bid to tame inflation, central banks are resorting to tightening of monetary policy. Yeah. That has implications for growth. As they tighten monetary policy, as they increase rates, of course, you should expect that cost of doing business will rise, cost of borrowing will rise, and that will impact on real GDP growth. So to that extent, I would say the 3.75 may not be realistic given prevailing circumstances and given global and domestic headwinds.
All right. I mean, it's very clear. You said the crude oil price benchmark is realistic, is doable, and
Yes,
of course the growth and inflation is something that is not feasible because of what is going to happen, especially decisions around subsidy, which is a very big political decision to watch out for next year. But Prof, let's look at the funding of the budget. The deficit is 6.31 trillion naira. That's massive. I mean, this has been a major concern. Even like you talked about subsidy, we're going to be spending about over 6 trillion naira if that is going to be sustained by the next administration. These are huge concerns. But I'm looking at the budget deficit now. What are the opportunities for leveraging the capital market? Because capital market is about long-term financing, and you've discussed this over time. You've seen how states also have been having a lag in even engaging the capital market for long-term funding. So let's look at the federal level. What are those opportunities we see for the 2023 budget?
Yes, this is one budget that is heavily weighted in favor of recurrent spending, which is why I think the impact on the capital market, particularly on the stock market, is not going to be salutary. You have an aggregate spending of 20.51 trillion.
Yes.
And out of that 20.51 trillion, you have recurrent spending of over 14 trillion. Okay, so you just have the capital component of 5.3. Now, remember, recurrent spending is divided into two. You have the recurrent non-debt, which is about 8.4 or thereabout, and then you have the debt service. Debt service is 6.3 trillion. So if you add debt service and the recurrent non-debt, you have over 14 trillion. Okay, so what we have for capital is very small. Now, a situation in which we have budgeted 6.3 trillion in excess of capital spend, which is 5.4, okay, it means that even the bulk of the borrowing or some of the borrowing will go into recurrent. The government says it intends to borrow 8.8 trillion, new borrowing 8.8 trillion. And capital expenditure is 5.35, 5.4. Now that means that the borrowing is also going to be in excess of capital expenditure. meaning that some of that will go to recurrent. So when you have that kind of situation, the uh, you know capital market, long-term growth, you don't create an environment that will sustain companies, will enable capital formation, and that is why capital uh, uh, market will suffer in a way next year compared to what we'll have this year. Yes, the government is going to borrow, and part of the borrowing will be done domestically, which people argue will further deepen the bond market. But again, remember that as governments borrow, the more government borrow from the domestic market, the more it crabs out opportunities for the private sector to go and borrow, and the more interest rates are driven up. Okay, so what you should expect next year is what I've always been forecasting, that a lot of interest will now shift from the equities market to the bonds market. This rebalancing or negative sentiment on the part of the equity segment will of course depress stock prices. So we are likely to going to see a bearish equities market in 2023 if the current trend continues. If the central bank continues to tighten monetary policy to tame inflation, and if inflation continues to rise and you have a situation in which the rate of return, real rate of return, is negative as we have it now. In the equities market, for example, year-to-date return is around 11.5% year-to-date return, and you have inflation rate at 20.52. So if inflation rate is 20.52 and you have return from the market at 11.5, that tells you is you have the return is already negative. And when you now factor in the exchange rate issue, the naira depreciation, okay, that further compounds the problem for an investor. So these headwinds, these challenges will rub off negatively on the market, in 2023, no doubt about that. But yes, the bonds, fixed income markets, will be the greatest beneficiary because interest rates were rising and including bond yields. So we'll see a lot of interest in that space. But essentially, the equity segment of the market is bound to drag, in 20. And we're beginning to see it. If you notice, between June and now, as we speak, no month has recorded any positive performance. From June right up to now, as we speak, every month has been in the negative territory. And this has more or less, seriously moderated the impressive performance we had from January to May of this year. So it's very much likely that the second half of 2022 will end in negative territory, and that will also linger. We'll see that lingering into 2023. Now, the major challenge I see with this budget, which why some people say is unimplementable, has to do with the major assumption underlying it. And that major assumption underlying it is that the fuel subsidy will continue to June and then will be removed by July. Now, remember that by July, we have a new administration, God willing, in Nigeria. And that new administration will just be assuming office and may not want to do that immediately. They want to have some time to settle in before removing. Yes, in order to create some crisis. So the issue of planning a budget and assuming it will go by July may not be feasible. Okay, and that's why I said that it is very much likely that the fiscal deficit will widen, and government borrowing will widen, will be more, on account of the fact that the new administration may want to also allow some time before dealing with the issue of, subsidy. So it's one proposal that is going to be affected by political risk, high political risk, which of course we know affects the market. The market is one that doesn't like uncertainty. Once there is uncertainty, it creates volatility, it dampens investor sentiment, and then you have the a market that is weak in terms of performance. Okay. Now, if you also look at what is happening from the global side, yes, bro. It's also not going to help the matters. Yes, we've just seen the CPI report for in the latest one from the US, talking about inflation rate at 8.5%. Now that's elevated, by any standard. It's unprecedented. In the Euro area, Eurozone inflation rate is rising, UK inflation rate is rising. So, and what has been the response? The central banks are tightening monetary policy, hiking rates. So we have seen in the last couple of months some capital flow reversals, from emerging markets to the US, and is also discouraging even investments into emerging markets, frontier markets, including Nigeria, because on a risk-adjusted basis, returns are higher in the US. So you notice with all this, with the dollar strengthening, with yields rising, that will also affect foreign portfolio investments in Nigeria. And on the part of the fiscal authorities, it's also affecting the cost of servicing debt. Cost of servicing debt is bound to rise with what's happening now. And that's why even what we have provided, 6.3 trillion we have provided, may not be sufficient to service our debt. Okay. It's bound to rise.
All right, thank you, Prof. I think let me continue, but if I get you clear, I mean, there's need for rebalancing because it will be more of a bonds and fixed income market affair next year. I even see the commercial papers increasing for private sector because if there's a crowding out to come in.
The recent issuances by the Debt Management Office, you see the one they've done now, and the FGM savings bond they also did. You can see they issued at a higher coupon. Yeah, so that's what we are. What are bound to get.
Because there has to be a rebalancing so that it's not the equities is not hit so hard, definitely. But in a minute, Prof, can you tell us about leveraging the capital market to list state-owned enterprises? This has been something that's been debated over time, and when you look at the Saudi Arabia example and other economies.
Privatization of public enterprises through the capital market is the way to ensure inclusive growth for the Nigerian economy, because when you do so, as opposed to selling those enterprises to just few individuals, when you bring them to the market, you allow for wider ownership. A lot more Nigerians can now take part in the fortunes of such companies. The challenge has always been the fact that many of these public enterprises are not usually healthy, and because they're not healthy, it's difficult to take them to the market immediately. But there should be a plan to eventually take them to the market after they would have been cured of whatever is troubling them. That's why I'm happy that the NMPC Limited also has plans to be listed on the exchange. So the 2023 budget has made provision for privatization of public enterprises. The government intends to get as much as 207 billion naira from such to be able to part finance the deficit. So my submission here is that such efforts should be done through the capital market. If government is privatizing public enterprises, they should be done through the capital market. That way, you also boost, you further deepen the market, and of course, you open the doors as it were for even more private issuers to come. Because when the government is patronizing the market, it's serving as a confidence booster. It's a signal. It's telling other people there that government has confidence in this market, and therefore you too can come. That's what it does. It's a door opener. So we want more public enterprises to be privatized via the capital market.
Thank you very much, Professor Uche Uwaleke, for this conversation. Very rich insights from the 2023 budget and, of course, the implications for Nigerian capital market. Thank you once again, Professor Uche Uwaleke, President, Association of Capital Market Academics in Nigeria. And good enough, ASU has suspended the strike, so definitely we're coming back to the classroom to engage students on capital markets. Thank you once again.
Thank you. Thank you, Abasi. My pleasure.
Thank you. And that'll be all for this edition of the Market Review. If you have questions or suggestions on the budget 2023 implications for the Nigerian capital market, please send an email to Ottoabasi.abasiekong@proche.co. Also, you can join our website, www.proche.co, to read our latest news, articles, stories, and reports on the capital market. You can also engage us via our social media platforms displayed on the screen. This period, we invite you to participate in the 8th edition of the Proche Online Trading Ranking Report. And to get further insights into this, you can log on to our website. Don't forget that you need to be informed to make the right investment decisions. Thank you for watching, and keep discussing the financial and capital markets, because they create wealth and economic opportunities.